There was a note from Bank of America, Savitha Subramaniam, who said that there are some playbooks that simply won't work in this environment where international tensions are rising, and that she actually thinks financials are a good sector to look at. They're not only undervalued, but less susceptible to these trade fears. Your thoughts?
I definitely think that's the case. I think the real benefit you see is that as the financials have come back from the downturn of 2008, 2009, profitability is better, balance sheets are in a better position. And despite all the rhetoric that's going on and all the noise, if you will, that's going on in the markets, there's really a great opportunity for the financials to be more profitable and better serve their clients.
Where are those growth opportunities?
We look at it across both on a regional basis in the United States as well as on a global basis. On a global basis, when you look at the emerging markets, there may be more emerging volatility, but you also see higher growth rates, 5% GDP in the emerging world. So if you can target that, or within the United States, when you start to think about California, the Southeast, those are really the opportunity sets for most regional banks.
Speaking of emerging markets, you talk about the growth, the growth targets increasing for the second half of this year, but there's also a lot of political uncertainty, especially in countries like India, 4 state elections coming up this year, that re-election of Modi coming up in 2019, and then in Brazil, I mean, it's a big cabinet reshuffle that is ongoing. So does that scare you as an investor?
It certainly gives us pause when we think about what could that mean for the overall economic outlook for those countries. But when you look at their PMIs and you look at how they're still trending higher and you think about where are we going to grow over the next 10 to 15 years, yes, short term, it could be problematic. But over the longer term, when you look at population growth, when you look at what they're able to generate via per capita incomes, we still see it as an opportunity, despite maybe some of that short-term volatility that we're seeing as, again, trade rhetoric heats up, concerns about the political climate. That's always going to be in the background, and we think you really have to look past that right now.
That seems to be what the market is doing. I mean, we should point out last week, the S&P 500 gained 1.5%, despite everything happening on the international front, from NATO, that epic meeting between President Trump and Prime Minister May, and now to the finale here with President Putin. Is it right for markets to be so disconnected from these international headlines?
We think that the markets are taking it all in stride, and more importantly, they're looking at what earnings are going to be. So if you look at the United States, and earnings are going to be approximately $160 a share for the S&P 500, at 17 times earnings, doesn't look cheap, but it also doesn't look overvalued. And when you look at it on a global basis, developed economies trading about 12 times, emerging markets trading about 11 times. We think that the markets certainly are going to be a little more volatile around that, but fundamentally, the earnings look good. So when you hear these comments coming out and you hear a lot of this rhetoric, we think there's probably more noise to it, again, a little more fluff to it, and the market's pivoting back to what's happening on the earnings front, and are they able to grow?
But geopolitics is affecting so much at the street level, and I don't mean just Wall Street, I mean Main Street too. We're talking to bourbon producers in Kentucky. I'm heading to North Dakota to talk to soybean farmers. When you have these big trade issues, it affects what people can spend, at the mom and pop shop level. How do you factor that into where you see growth in the future and how you plan for volatility?
And the impact it has on sentiment, too.
Right. I think the greatest concern that we have as it relates to inflation, and to your point about if you're in Main Street, what are you paying for that next box of cereal? What are you paying for gas? Exactly. And you think about, where are we going to make up that extra supply? We heard the comments over the weekend from Iran. When you look at what the comments have been as relates to this summit and with Russia, where's the oil going to come from? There's only so much we can do as a domestic producer, and we're seeing shale pick up and we're seeing other opportunities. But fundamentally, do we think it's going to cost more at the grocery store, at the pump? And that is disconcerting from a consumer sentiment standpoint. We haven't seen it yet, and I think that's what we're watching over the next 6 to 12 months is, do you see that pivot? Do you see inflation starting to pick up? And then fundamentally, can earnings not keep up with that as it relates to costs?
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.